All right, let's talk about SOFi Technologies. This is one of those fintech stocks that has just been on an absolute tear, and everyone's watching it. So today, we're going to break down how traders and investors are looking at it from all angles: the good, the bad, and everything in between. I mean, this is the big question, isn't it? It's what every investor secretly or not so secretly hopes for. But people are asking this for a very specific reason, and that's because of the stock's jaw-dropping performance. So, how wild has it been? Yep, 510%. That's its price growth over just the last 3 years. When you see a number like that, it's hard not to wonder if you're looking at a golden ticket. But as you probably know, a headline number like this almost never tells the whole story. So, before we get too swept up in the excitement, we've got to pump the brakes a little and get grounded in reality. It's time to separate the dream from the actual disciplined strategy. And this quote right here, it really says it all. You know, putting all your hopes and dreams on one single stock to make you rich, well, that's not really investing, is it? That starts to feel a lot more like gambling. Look, we all want to find that next stock that goes up 50 or 100 times. But the honest truth is, you just can't predict those things. It's impossible. But just because it's not a guaranteed path to riches doesn't mean there isn't something really interesting happening with the company itself. And this is why SOFi is such a fascinating case study. Take the get-rich-quick fantasy off the table, and you've still got a business that is absolutely firing on all cylinders. I mean, profits are up, revenue is soaring, and they're adding new customers like crazy, all while rolling out new products. It's these strong fundamentals that create this incredible tug-of-war in the market. And that tug of war, it really boils down to two opposing camps. You've got the bulls, who see those strong fundamentals and are betting the stock is only going to go higher. And then you have the bears, who see that massive run up and think what goes up must come down, or maybe they just want to protect the profits they've already made. So let's dig into both of their game plans. Okay, first up, let's talk about the optimists, the bulls. They aren't just buying blindly. They're watching for very specific signals to make their move, and they usually follow one of two main playbooks. So, the first strategy is what you'd call the trend follower. The idea here is simple: ride the momentum. These traders wait for confirmation. They want to see the price punch through that key $29 resistance level, and they want to see it happen with a lot of trading volume. If they get that trigger, they're in, aiming for new highs. But, and this is so important, they always have a safety net, that stop loss, ready to get them out if the trend breaks down. Now, the second bullish play is for a totally different personality, the dip buyer. These traders are more like bargain hunters. They're not chasing the stock up. They're waiting patiently for it to pull back to a key support area, in this case, around $24 to $25. They're betting on a bounce. It's a completely different approach, but the discipline is exactly the same. Have a clear entry, a clear target, and a firm stop loss. Okay, so we've heard from the bulls, but every trade has another side of the story. So let's flip the script and look at the bearish counter moves for people who think this stock might be headed for a fall. The first bearish play is essentially the mirror image of the trend follower. It's a momentum short. These traders are watching that exact same $29 resistance level. If the stock pushes up to it and runs out of steam, or if it breaks down below $26, they see that as weakness. They'll then place a bet that the price is going to fall while setting their own stop loss just above that resistance zone in case they're wrong and the stock rips higher. Now, not every bearish move is about trying to profit from a drop. Some are just about playing defense. This strategy, hedging, is for investors who already own SOFi, like the company long-term, but are maybe a little nervous about a short-term dip. They can use tools like put options to buy some insurance on their position. It limits their potential losses for a relatively small price. It's a smart, defensive play. So we have the bull setups and the bear setups, but honestly, no matter which side you're on, none of it matters if you don't understand the outside factors and the risks that can come out of nowhere and completely change the game. And here's a big one that's affecting SOFi right now. The company just raised $1.5 billion by selling new shares of stock. Now, this is pretty common for a high-growth company. They need cash to expand. But for traders, it means there's suddenly a flood of new shares on the market. That creates supply pressure, which can act like a temporary ceiling on the stock price. And that's just one piece of the risk puzzle. You also have to remember SOFi's high volatility. It's got a high beta, which is just a fancy way of saying it tends to make bigger swings than the overall market. That means your stop losses need to be a little wider. And finally, you've got news. A surprise earnings report or some other announcement can just throw any trading plan right out the window in an instant. So, the most important thing to take away from all this is that these are frameworks for how to think about a trade. This isn't financial advice. The whole point is to show you the disciplined process traders use to make a plan, define their risk, and stick to it no matter what. So, there you have it. The bullish playbook, the bearish countermoves, the key levels, the biggest risks, all the pieces are on the board. The only question left is, what happens next? Thanks for turning in to this explainer.